Hello, everybody. Welcome back to 21st Century Renaissance, and welcome back to another open interest newsletter breakdown with me, your host, Dr. Michael LoPiano. Today's topic, bull run or bull trap? Okay, so very exciting yesterday. We got some late day price action, pushing us up into the after hours, approaching 30. Pretty sizable volume late in the day. We close in the day with a pretty sizable bullish imbalance in the options market. We have quite a bit of unusually bullish options flow at a couple strikes, but are we necessarily moving into an unmitigated bull run? Is this the beginning of some crazy upwardly volatile thing like what we saw in 2021, or is this just another stepping stone on the way to something like that? What really are we looking at here? When we have these moments, when I see these moments of upward volatility seemingly kind of pop out of nowhere, I become instantly wary. I become instantly wary because I've seen so many of these movements have a lot of promise, build up a head of steam, and then all of a sudden, when things look like it's nothing but clear skies, something happens, the price comes back down, and then, it's another week closing below $30. I will remind maybe some of our new viewers here, maybe some new readers of my weekly newsletter here on GameStop. I should say my daily newsletter here on GameStop, my daily price action forecast and options market analysis. Even at these hugely upwardly volatile days that we saw last May and last June, we still had no single week in GameStop close above $30. So I'm very wary of this. I've seen especially a lot of hype pop up on places like, some of it on Twitter, obviously on X, but, top 5 or so articles or posts on something like Superstonk. It's, a lot of hype, a lot of excitement, calling out these unusual call bets, calling out this upward price volatility. So we're going to think about that and walk through some of how I'm thinking about this. I am especially wary of potential market maker shenanigans. Okay, so let's get into some of our data and walk through how I'm thinking about this in particular. So the first thing I suppose I was thinking about in terms of going through something like a pattern or historical comparison to what we were looking at in 2020 and into 2021 was looking in particular at our run-up on a week-to-week basis. Okay, so there's this recoil thesis out there, this idea that maybe we're retracing our steps through some key moments in the 2020-2021 GameStop saga, or that phase of the GameStop saga. And, a date that stood out has been something like January 9th, based on this Time U cover meme that Roaring Kitty posted 2 weeks ago. And so there's been some speculation about what January 9th means, or I don't know, T+35 stuff or settlement stuff or FTT stuff or something like that, right? There's always these calculations or something you see on Superstonk. Maybe, right? I don't know, right? I don't know. But I will say that on January 9th, I did find, Ryan Cohen posted this meme that's been actually since deleted from his Twitter. And it was one day before he published his filing to officially join the GameStop board, which was on January 10th. So I looked back, I saw something like that, and I thought, okay, well, what really did GameStop do in that period leading up to Ryan Cohen's decision to join the board? And really, what we find out, I'll move down to our technical section here, is we find out that the situation looks something like this. So in 2020, we actually didn't have any major technical breakouts. We didn't violate our predominating technical paradigm heading into the end of 2020. And it actually kept form into the early part, just a few days before January OPEX in 2021. What we see here, this really crazy big up move, this huge, 100% move in GameStop in a day, right? And then, kind of heading where GameStop moved from from $20 all the way up above $40. So this is actually where, in the midst of this, is way back in 2021 when I actually officially bought into GameStop. Right, I had been watching it in here. I was interested in a lot of the memes that were coming out of Wall Street Bets and stuff, something like that. But I actually didn't put any money into GameStop until something like, I want to say it was January 11th or 12th. So it would have been on this particular red day back in right before January OPEX, right? Yeah, that's not the 12th. That's something like the 13th, 12th to 13th, somewhere in there. But in any case, my point of pointing this out is that we didn't get this huge exponential move in GameStop until Ryan Cohen filed his intention to join the board of GameStop in January of 2021. We didn't get that type of move until then. Now, exactly what caused that is a different question. It's speculated, it's been discussed by a number of different people, that there were several sorts of things going on in the background that compounded on one another that led to this exponential increase. I won't address that too much now, but I will say that until that sort of last straw was put onto the balance, onto the scale, we largely stuck to a series of measured moves that were trading, right, our predominant chart at the time, where the chart upon which our predominating sort of day-to-day and week-to-week technical paradigm was in place was on our daily chart. We had formed a bullish regression channel, and our price was, right, our price action very, very scrupulously respected this major bullish regression channel into 2021. Actually, you can't see it on this chart, but it goes all the way back into August of 2020 when Ryan Cohen first started buying in to GameStop and started this, what looks to have started this initial move up. So yes, even though Ryan Cohen bought into GameStop increased his position by about 30% following Q3 earnings in 2020, we did not see a deviation from that technical paradigm. So, it looks something like this, right? We traded up until the price, just got a bit overextended from this. I think this is back in September. Traded down, we move into our bearish regression channel here. This sub channel transforms along this period into something a bit more range bound, and then we trade up. We move just out of the top of the upper bound of the bullish regression channel, and then trade back down. Right, this is Q3 earnings here in December. We traded down out of Q3 earnings. We had a week of down trading. We had a pretty sharp bearish regression channel that again transformed into something a bit more range bound. We traded up a little bit just underneath the midline of the bullish regression channel into December OPEX, which was on which was on December 18th of that year. And then it was only coming out of December OPEX did we then have a bit of a bigger bullish move up through the midline of that bullish regression channel. This, of course, was on the back of, this was a T plus, looks like it's connected to a T+2 option settlement event, right? So through this range, this week is where we had Ryan Cohen. This is where, he's actually buying his shares, right? So we did get this bullish sort of upward trend that stuck within this slightly bearish but more range-bound regression channel out of December OPEX into the 21st, right? On the 21st, in the evening, I think around 3 p.m., 2:30 p.m. is when Ryan Cohen dropped his amended 13D, having revealed that he increased his position size, or I should say RC Ventures position size by about 30%. And then we got these two pretty, this big bullish candle and these 2 days of pretty heavy bullishness into, well, I guess this would be into Christmas, right? So into our half day on Christmas Eve. We kind of hung out there around Christmas Eve, into Christmas Eve. We moved back out of this channel, immediately coming back from the Santa run, sometimes it's referred to. And then for a full trading week leading into New Year's, bearish into the end of the year. And then the following week, right, also bearish, transforming, moving into a consolidating kind of range-bound area that's flirting around the midline of our bullish regression channel. And then even out of that week, okay, we traded up a bit, but only to about the top of this slightly more bearish, not quite fully range-bound regression channel into early January, right, into the second trading week in January. So all of that took place following Q3 earnings, even amid this insider buying, Ryan Cohen's buying into his reveal of his amended 13D. And it wasn't until he announced his intention to join the board via SEC filing on January 10th did GameStop finally go into this really exponential type of move. So, right, I'm keeping that in mind, certainly as we look at our current technical paradigm, which has a similar shape. It's on a smaller time scale. We're not using a daily chart to determine our predominant technical paradigm. We're using the 4-hour chart. And we see a similar type of move. Okay, it's not exactly the same, but let's say the pattern archetypes of that move in 2020 are reflected in some ways here in 2024. So we've maintained our bullish uptrend, right? There were some attempts to thwart this over the past couple of weeks, as I've mentioned a few times. And as we've traded in this, right, we've been pretty much bounded, except on these consequently both relatively bearish days and then quickly reversing into heavy bullish days, especially these candles around Roaring Kitty's tweet and the earnings report. We've pretty much stayed within the lower bounds of our bullish regression channel. So below the midline of this channel and above this support line for pretty much the entire time, right? We've only kind of dipped below this mark on that after hours earnings candle that we saw. So now, as we can see with yesterday's price action and with our after hours price action, with today's pre-market price action, we are pushing up against that midline as a potential resistance mark. It has served as a resistance mark and as a support market at different points, basically while we've been in this lower channel, and a bit right toward the early part of November and the beginning of our bull run following National Cat Day. We could certainly reverse at this midline. Right? We could trade sideways into December OPEX and then only kind of move out of that a little bit later, certainly as we close our distance between the 200 4-hour moving average and our bull trend support line. This is possible. We could, of course, over this period of days, we could move through this resistance line and we could test the upper portion of our bullish regression channel at around $33. That's around slightly higher than where we reversed the last time we extended out of that top bound. But in either of these cases, what seems most likely is that whatever is going on in the background now, okay, we don't really know what's going on. It did look like there was some buy pressure that came in late in the day. It was not primarily induced via the options market, although a lot of it was continued or fed or built upon by the options market, what was going on in the options markets, and particularly bullish call flow. It was not a lit whale trade, at least not on anything that could be picked up on unusual whales, and it was, nothing came out of a dark pool, right? It wasn't like there was a crazy big dark pool buy and then the options market dogpiled on top of that to chase some of that. Right, we didn't see anything like that. Don't know where those, say, 300,000 or 400,000 shares that just kind of popped out of nowhere came from. Maybe this was something like settling a short position or covering or closing a short position that had been opened, back here, right? Think about this. Any of the shorts that entered, we saw, a lot of shorting, even in this range, even around 27, 26, right back before we got Roaring Kitty's tweet, that really caused this big reaction back up into, even this upper half of our bullish channel. there was a lot of shorting, not as much as here immediately after Thanksgiving, but certainly a few tactical deployments of about 100,000 shares of short volume that we just don't know if whoever did that actually covered that trade. It did look like early on in the day there was about 200 to 250,000 shares sold short to sort of begin our price action. We don't know. Maybe part of this that we saw later was a short deploying this volume and covering within the same day all at once. Usually shorts don't cover their positions immediately or very fast because it creates a very quick reversal that might stimulate some excitement in the options market. And you could end up as a short trying to close your position. You could lose out on profit because the corresponding response from the options market, if you don't get enough sort of stop loss hunting, if you don't get enough sell pressure to kind of join you in that momentum, if you don't get enough bearish sympathetic pressure on your down move, as you cover, if you cover quickly, it could you could end up losing money on that trade. It might not work for you as well as you might like. But because our IV levels had gotten pretty low yesterday, and it did look like there was a lot of very intense targeted call flows at a few select way out of the money strikes. The January 125 calls saw a huge amount of volume and acquired something like over 46,000 contracts, new open contracts, primarily at the ask yesterday. We saw the 60s going into, I guess, next week. Yeah, next week's $60 calls, over 11,000 new $60 calls were open long for next week. So, I don't know who's making these trades, but it's very possible that, maybe there was this early shorting, carried IV down, and then, I don't know, it was calculated that while this short covering was taking place, simultaneously a fund, some kind of institution may have gone and bought up these out of the money calls that had been beaten down by this IV crush following earnings over the past few days. If that's the case, right, then what that sets up is something like an environment where now whoever is now holding those calls, especially because they're so far out of the money, yes, okay, they could hold them into a crazy high upward volatility event. But the easier play there, right? Some of these contracts are already up like 300 or 400% just in those 15 minutes of trading to close the day, heading into today's trading. This might be an attempt to some of this hype might be an attempt to generate some exit liquidity for whoever opened those calls, right? So they can kind of hot potato them off. They can kind of dump them off on somebody else and say, okay, you try to make money on this now. We're already up 300%. We don't need to keep riding this thing. We had our calculated move at the time it dropped. So, something like that is possible. Like I said, if we do go look at our OI, you can take a look at this in greater detail in the article, which is posted on X. You can find it down in the comments, in the description of this video if you're watching this on YouTube. Despite all this action, right, pretty modest increase in our max pain to about $26. It might go up again, especially if we see some put sales, some out of the money put sales, something like that. Put volume, new put OI has a tendency to raise our max pain since it incentivizes, right? It sort of acts as a counterweight versus all of these out of the money calls that we typically see. We might see something like that, but it's good to keep in mind. We're pretty decently above our max pain. We do have that big $30 call OI position above us. It's still early in the week. We could get some legs on this up move early in the week. But again, because of the frequency by which we've seen even the most dynamic of upward moves that look like, oh my gosh, the absolute doors have been blown off of this. Market makers, dealers, institutions, they've got to be scrambling around, like get the hedgies or something like that, right? So far, what we've seen is the price still ends up below 30. Still ends up below 30. Still ends up with the vast majority of calls expiring out of the money. And what makes this profitable, what actually makes say a max pain finish even at like 28 or 29 when you have such a call heavy options chain. What makes that profitable for market makers is when we see IV levels correspondingly jump pretty high. And we did see that. We did see a pretty significant IV jump late in the day. Certainly Schwab was reporting around a 20 to 25 percentage point jump in IV late in the day. So, that's what's really jacking up the IV values on these, or I should say the total value on some of these out of the money, way out of the money calls. Okay, right. What that's going to do now on the flip side is this is going to incentivize selling. It's going to incentivize, it certainly makes it easier for dealers to remain properly liquid enough to continue with their hedging strategy, with their dealer strategy, their market making strategies, to be able to hedge within these, to hedge their positions in order to continue to provide liquidity to an options market that wants contracts, without getting margin called or sending their whole portfolio across all of their different tickers, making it so completely unbalanced that all of a sudden they have to sell off all these positions in order to get liquidity in order to continue with market making on GameStop, right? They really jack up IV, so then their credits are that much higher, right? The premiums that they are taking in as a credit from call buyers then provides the necessary liquidity for them to go ahead and continue to hedge their positions appropriately without sending their entire portfolio or their portfolios into a state of unbalance. If we look at our gamma exposure, right, we definitely see put to call gamma exposure ratio definitely looking like we're moving into this type of bull trend. We're moving into a 1-to-5 put to call gamma ratio. That certainly suggests bullish. Okay, yes, we're in the bullish conditions. That just happened yesterday before the close. If we look at our daily GEX, yeah, a lot more green on the board. We definitely see ourselves now right within the middle of this dense cluster of call gamma. Path of least resistance, I would say, based on this, is something like trading again, right? This maps this $28 to $20 to $30 range, this $2 bracket, pretty much lines up exactly with what we're looking at in that lower half of our bullish regression channel. Path of least resistance is kind of bumping around in here, and we do have a lot of gamma at 28, at 29, call gamma, especially at 29, that keeps us trading stably, that lessens volatility. But we have so much here at 30 that's really going to make, especially early in the week, options-induced moves, unless it's crazy heavy for some reason, or we get some of this external buying pressure like we saw. Maybe it's short covering, who knows? Maybe it is insiders buying that's getting fed to the lit market. Unless we see something like that, just kind of options flows are going to have a hard time really definitively breaking through this call wall. Could happen. But, based on our structure up above 31, we could definitely move through 30, right? We could move into this kind of 30 to 31 bracket, hang out there kind of midweek. But if we don't get more calls and more call gamma piling up in this 31 to 33 range, this hedging becomes uneven. It becomes risky because now we're moving to the top end of this range, the top of this range. It's going to require capital commitments, right? There's just way less certainty, way more risk as we move to the top of that range. Hanging out, yeah, I could see us if we move up pretty hard today. If we do get some more of that buying, yeah, options market, I think, could entertain some trading in the 30 to 31, right? We could even, if it's really heavy, yeah, we could move up here. But I think kind of holding this position, especially because of what we've seen, how we've seen market makers, how we've seen this kind of short volume pop out of nowhere sometimes and push us back under that $30 mark, I am particularly cautious about betting on a close above $30, especially given how dramatic of an IV jump we saw yesterday. So I go into this in a bit more detail. I also walk through some of how these IV jumps work, especially from a dealer perspective, how they incentivize the market in a number of different ways to help dealers protect their hedging liquidity. or the liquidity that they would use in order to pursue the necessary hedging to protect, their fund's integrity, to protect their profitability in the face of, within the context of their role as designated market makers. So I talk about that a bit. Would definitely recommend checking that out. I also go into a bit more detail in terms of some of the things that we saw take place in 2020, a bit more of the technicals in terms of, how I've talked about even a bullish week this week, even moving up into the top of our channel does not necessarily and did not necessarily correlate back in 2020 with a paradigm break. That a number of compounding elements, events, underlying mechanical structures had to come together in with respect to permitting and generating that type of exponential move that we saw in later January, beginning around January 10th, when Ryan Cohen announced his intention to join the GameStop board. So I mean, in our long-term outlook, definitely staying bullish. It looks great. I mean, this bullish regression channel does not look like it's in danger. Its structural integrity is in danger. We had some threats to that. One just before earnings, or right around earnings. One the week before earnings that Roaring Kitty's tweet protected us against, or the reaction to his tweet protected us against. So I'm not seeing threat there. It really looks like we're just going to stick in this technical paradigm, and in the short term, right? I would say sort of the bearish kind of moving into this range below that bullish regression channel, I would say is definitely weakened by how we responded to that test of the lower end of our bullish regression channel yesterday. However, I don't see anything yet that would suggest to me that we would completely shatter or break out of this bullish regression channel, that suddenly we should expect something like a massive exponential move to pop out of nowhere. And in particular, with respect to, my own trading, with my own investment, I'm being particularly careful not to be drawn in by the temptation that, maybe things are going to run away, right? I'm not seeing something like that yet, so I'm staying on guard. But right, as always, none of this is financial advice. None of this is trading advice. I hope that the way that I look at data, the way that I think through some of these contexts, the things that I can sort of look at can be a resource to the general investing community, to the general GameStop investing community, my fellow investors in GameStop, to help in general this community and my fellow investors make better independent decisions with respect to their investment. With that being said, right, I am, of course, still I have a great positive outlook on the stock, and very excited to see us behave in the way that we did, right? Just exercising some caution and looking in particular to be led best by what I'm seeing in our data. So thanks very much. Do give the article a look. Do give it a read if you'd like to see any of this broken down in more detail. And you can find that, as I said, linked down in the description of this. If you're on YouTube, if you're watching this on X, right, it's up at the top of the page. Let's see. Things are certainly getting exciting. It continues to be engaging to follow the stock. So let me know in the comments what you think. If you have any questions, happy to answer them. Certainly happy to receive feedback so we can keep getting better here with these open interest newsletter breakdowns. So thank you very much, everybody, for watching and listening. We'll see you tomorrow. Take care now.